Question 1. The risk matrix shows a clear segmentation of customers based on their risk profiles, with a particular segment identified as having a higher propensity for certain types of financial distress. The firm is considering implementing stricter controls and higher fees for this segment. Which of the following represents the most appropriate next step in treating risk for this customer segment, considering the regulatory framework? Option A. Make minor adjustments to the risk matrix to slightly reduce the perceived risk of the segment, without a comprehensive review of the underlying data or impact. Option B. Reclassify the identified segment as a customer service issue rather than a risk management concern, and delegate further action to the customer service department. Option C. Conduct a thorough review of the risk matrix's outputs to identify any potential for unfair treatment of vulnerable customers, and engage with relevant stakeholders to refine the risk assessment process. Option D. Proceed with the implementation of stricter controls and higher fees for the identified segment, as the risk matrix provides objective data for risk mitigation. The correct answer is C. Conduct a thorough review of the risk matrix's outputs to identify any potential for unfair treatment of vulnerable customers, and engage with relevant stakeholders to refine the risk assessment process. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of risk assessment beyond simple identification. The firm must demonstrate a commitment to treating customers fairly, a core principle embedded within the regulatory framework governing financial services. The challenge lies in balancing the need for efficient risk management with the ethical imperative to avoid disproportionately impacting vulnerable customer segments. Careful judgment is required to ensure that risk-ranking methodologies are not only effective in identifying potential threats, but also equitable in their application. The correct approach involves a thorough review of the risk matrix's outputs to identify any potential for unfair treatment of vulnerable customers, followed by a proactive engagement with relevant stakeholders to refine the risk assessment process. This aligns with the regulatory expectation that firms conduct their business with integrity and due skill, care, and diligence, and specifically with the principles of treating customers fairly. By seeking to understand the impact on vulnerable customers and engaging in dialogue to adjust the methodology, the firm demonstrates a commitment to ethical conduct and regulatory compliance, ensuring that risk management practices do not inadvertently create barriers or disadvantages for those who may be less able to manage financial risks. An incorrect approach would be to proceed with the current risk matrix without further investigation, assuming that the quantitative outputs are inherently objective and fair. This fails to acknowledge the potential for systemic bias within risk assessment models and overlooks the regulatory duty to consider the impact on all customer segments, particularly vulnerable ones. Another incorrect approach would be to dismiss concerns about vulnerable customers as outside the scope of risk management, treating it solely as a customer service issue. This compartmentalization is a regulatory failure, as risk management and customer treatment are intrinsically linked under the principle of treating customers fairly. A further incorrect approach would be to implement superficial adjustments to the risk matrix without a deep understanding of the underlying issues or without consulting with those affected. This demonstrates a lack of genuine commitment to fair treatment and may not adequately address the identified risks or their impact. Professionals should employ a decision-making framework that prioritizes a holistic view of risk, integrating quantitative data with qualitative considerations of fairness and ethical impact. This involves actively seeking out potential unintended consequences, engaging in cross-functional collaboration, and maintaining an open dialogue with both internal and external stakeholders. When faced with a situation where risk assessment outputs might disproportionately affect certain customer groups, the professional reasoning process should involve 1. Acknowledging the potential issue and its regulatory implications. 2. Investigating the root causes of the potential disparity. 3. Exploring and evaluating alternative risk assessment methodologies or adjustments that mitigate unfair outcomes. 4. Documenting the decision-making process and the rationale for any chosen course of action. Question 2. The audit findings indicate that the organization's bow tie analysis for a critical operational risk has been updated to reflect new threats, but the review of preventative controls has been limited to a simple checklist verification without assessing their actual operational effectiveness. Which of the following represents the most appropriate response to these audit findings? Option A. Focus on enhancing the mitigating controls within the bow tie analysis, as these are typically more critical in managing the impact of an event. Option B. Update the bow tie analysis documentation to include a more detailed description of the preventative controls, even if their operational effectiveness has not been fully verified. Option C. Acknowledge the audit finding and inform the auditors that the preventative controls are considered adequate based on their documented existence. Option D. Conduct a detailed assessment of the operational effectiveness of all identified preventative controls and develop specific action plans to address any identified weaknesses, ensuring these actions are integrated into the overall risk treatment strategy. The correct answer is D. Conduct a detailed assessment of the operational effectiveness of all identified preventative controls and develop specific action plans to address any identified weaknesses, ensuring these actions are integrated into the overall risk treatment strategy. Explanation: this scenario is professionally challenging because it requires the risk manager to interpret audit findings related to a bow tie analysis and determine the most appropriate course of action based on regulatory expectations for risk management. The challenge lies in distinguishing between a superficial review and a robust, compliant approach to risk assessment and mitigation, particularly when the audit highlights potential shortcomings. Careful judgment is required to ensure that the response addresses the root causes identified by the audit and aligns with the principles of effective risk treatment, as expected by regulatory bodies governing the successfully treating risk exam. ARM 402. The correct approach involves a comprehensive review of the bow tie analysis, focusing on the effectiveness of both preventative and mitigating controls, and then developing a targeted action plan to address any identified gaps. This aligns with regulatory expectations for proactive risk management, which mandate not only the identification of risks, but also the implementation and ongoing assessment of controls designed to prevent their occurrence and minimize their impact. A thorough review ensures that the bow tie analysis is a dynamic tool, not a static document, and that the organization is demonstrably treating risks effectively, as required by the spirit and letter of risk management regulations. An incorrect approach that focuses solely on updating the documentation without addressing the underlying control deficiencies is professionally unacceptable. This represents a failure to treat risk effectively, as it prioritizes form over substance. It violates the ethical obligation to manage risks diligently and the regulatory requirement to implement controls that actually reduce risk exposure. Another incorrect approach, which dismisses the audit findings as minor without proper investigation, demonstrates a lack of due diligence and a potential disregard for established risk management processes. This can lead to a false sense of security and leave the organization vulnerable to the very risks the bow tie analysis was intended to address, thereby failing to meet regulatory standards for risk oversight. Professionals should employ a decision-making framework that begins with a thorough understanding of the audit findings and their implications. This involves critically evaluating the identified issues against established risk management frameworks and regulatory requirements. The next step is to assess the root causes of any deficiencies highlighted by the audit. Based on this assessment, a prioritized action plan should be developed, focusing on implementing practical and effective controls. Finally, professionals must ensure that the effectiveness of these actions is monitored and reported, demonstrating a commitment to continuous improvement in risk management practices. Question 3. Operational review demonstrates that a commercial property insurance policy contains a standard deductible for property damage, a per-occurrence limit for business interruption, and several specific exclusions related to certain types of water damage. A claim arises from a fire that caused significant property damage and subsequent business interruption due to smoke and water damage from firefighting efforts. The risk manager is tasked with assessing the claim's initial coverage parameters. Which of the following actions best reflects a risk management approach aligned with regulatory expectations for policy provision interpretation? Option A. Immediately apply the water damage exclusions to the entire claim, as the policy lists them, and then deduct the property damage deductible from the remaining amount before considering the business interruption limit. Option B. Apply the property damage deductible to the total loss amount, then assess the business interruption claim against its per-occurrence limit, and scrutinize the water damage exclusions to determine if they apply to the firefighting water damage, ensuring any exclusion is clearly and unambiguously worded in the policy before denying coverage for that specific cause. Option C. Apply the property damage deductible to the business interruption loss instead of the property damage, and assume the water damage exclusions are intended to cover all forms of water damage, including that from firefighting. Option D. Interpret the business interruption limit broadly to cover all consequential losses, regardless of the per occurrence wording, and waive the property damage deductible to expedite the claim settlement. Correct answer is B. Apply the property damage deductible to the total loss amount, then assess the business interruption claim against its per occurrence limit, and scrutinize the water damage exclusions to determine if they apply to the firefighting water damage, ensuring any exclusion is clearly and unambiguously worded in the policy before denying coverage for that specific cause. Explanation: this scenario is professionally challenging because it requires the risk manager to balance the insurer's financial interests with the policyholder's reasonable expectations and the regulatory obligation to ensure fair treatment. Misinterpreting or misapplying policy provisions like deductibles, limits, and exclusions can lead to underpayment of claims, disputes, and regulatory sanctions. Core challenge lies in interpreting these provisions in a manner that is both legally sound and ethically defensible, ensuring that the policyholder receives the coverage they purchased, while the insurer manages its risk exposure appropriately. The correct approach involves a thorough and objective interpretation of the policy wording, considering the specific circumstances of the claim and relevant regulatory guidance on policy interpretation. This approach prioritizes clarity, fairness, and adherence to the spirit and letter of the insurance contract and applicable regulations. Specifically, it requires the risk manager to 1. Ascertain the precise meaning of the deductible, limit, and any applicable exclusions as written in the policy. 2. Evaluate whether the claim event falls within the scope of coverage, considering any definitions or conditions precedent. 3. Apply the deductible and limit correctly based on the covered loss amount. 4. Determine if any exclusion is clearly and unambiguously applicable to the loss. This aligns with the regulatory framework's emphasis on clear policy terms, fair claims handling, and the principle that exclusions should be narrowly construed and clearly communicated. The regulatory framework for the Successfully Treating Risk Exam, ARM 402, emphasizes the importance of understanding and applying policy provisions to ensure accurate risk assessment and fair claims outcomes, thereby upholding the integrity of the insurance contract and consumer protection. An incorrect approach would be to interpret the deductible, limit, or exclusions in a manner that unduly favors the insurer at the expense of the policyholder, without clear contractual or regulatory justification. For instance, applying an exclusion that is ambiguous or not clearly worded in the policy, or interpreting a limit in a way that is inconsistent with the policy's intent, constitutes a regulatory and ethical failure. This can lead to allegations of unfair claims practices, breach of contract, and potential regulatory penalties for misrepresentation or bad faith. Another incorrect approach would be to overlook or misapply the deductible, either by not applying it when it is clearly stipulated or by applying it incorrectly to non-covered items, which also undermines the contractual agreement and regulatory expectations of accurate claims processing. Professional decision-making in such situations requires a systematic process. 1. Understand the policy contract thoroughly, paying close attention to definitions, conditions, exclusions, deductibles, and limits. 2. Gather all relevant facts pertaining to the claim. 3. Consult internal claims handling guidelines and legal counsel if ambiguity exists. 4. Apply the policy provisions and relevant regulations objectively and consistently. 5. Document the decision-making process clearly, justifying the application of each provision. This process ensures that decisions are well-reasoned, compliant, and defensible, fostering trust, and upholding the principles of fair insurance practice. Question 4. Governance review demonstrates that the firm's risk management function is struggling to consistently assess the probability and impact of emerging cyber threats due to a lack of granular historical incident data. The Chief Risk Officer is considering several approaches to address this gap. Which of the following approaches best aligns with the principles of effective risk assessment and regulatory expectations for managing complex, data-scarce risks? Option A. Prioritize assessment of risks with readily available historical data, deferring the assessment of emerging cyber threats until more specific incident data becomes available. Option B. Implement a system that relies solely on the subjective opinions of the most senior IT security personnel, without formal validation or cross-referencing. Option C. Conduct a broad, high-level assessment of all potential cyber threats using generic industry benchmarks, without attempting to tailor the probability and impact to the firm's specific context. Option D. Develop a framework that combines qualitative expert judgment, scenario analysis based on industry threat intelligence, and the use of proxy data from similar organizations to estimate probability and impact. The correct answer is D. Develop a framework that combines qualitative expert judgment, scenario analysis based on industry threat intelligence, and the use of proxy data from similar organizations to estimate probability and impact. Explanation. This scenario presents a professional challenge because it requires balancing the need for accurate risk assessment with the practical limitations of data availability and the potential for subjective bias. The firm must ensure its probability and impact assessment are robust enough to inform effective risk treatment strategies, as mandated by regulatory frameworks that emphasize a data-driven and objective approach to risk management. The challenge lies in implementing these principles when faced with incomplete historical data or when the qualitative nature of certain risks makes precise quantification difficult. Careful judgment is required to select appropriate methodologies that acknowledge these limitations while still providing a reliable basis for decision-making. The correct approach involves utilizing a combination of qualitative and quantitative methods, tailored to the specific risk and available data. This might include expert judgment, scenario analysis, and the use of proxy data where direct historical data is absent. This approach is correct because it aligns with regulatory expectations for a comprehensive and proportionate risk assessment. By acknowledging and addressing data gaps through reasoned estimation and expert input, the firm demonstrates due diligence and a commitment to understanding its risk landscape. This methodology supports the development of appropriate risk mitigation strategies, ensuring that resources are allocated effectively to address the most significant threats. Ethical considerations are met by striving for objectivity and transparency in the assessment process, even when dealing with uncertainty. An incorrect approach would be to solely rely on readily available, but potentially incomplete or irrelevant, quantitative data. This fails to capture the full spectrum of risks, particularly those that are emerging or difficult to quantify. It also risks misallocating resources based on a skewed perception of risk. Ethically, this approach could be seen as negligent, as it does not demonstrate a thorough effort to understand and manage potential harm. Another incorrect approach would be to over-rely on subjective expert opinions without any attempt at validation or cross-referencing. While expert judgment is valuable, unchecked subjectivity can introduce significant bias, leading to inaccurate assessments and ineffective risk treatments. This approach fails to meet the regulatory requirement for objective evidence and can undermine the credibility of the risk management framework. A further incorrect approach would be to postpone risk assessment due to perceived data deficiencies, effectively ignoring potential risks. This is a direct contravention of regulatory obligations to proactively identify and assess risks. It creates a significant ethical failing by exposing stakeholders to unmanaged risks and failing to uphold the duty of care. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the risk being assessed. Second, identify all available data sources, both quantitative and qualitative. Third, evaluate the quality and relevance of the data. Fourth, select appropriate assessment methodology, considering the nature of the risk and data limitations. Fifth, document the assessment process, including any assumptions made and the rationale for estimations. Finally, regularly review and update assessments as new information becomes available or the risk landscape changes. This systematic process ensures that risk assessments are thorough, defensible, and aligned with regulatory and ethical standards. Question 5. Consider a scenario where an organization is seeking to enhance the efficiency and effectiveness of its risk management program. Which of the following approaches would best align with the principles of process optimization within the Successfully Treating Risk Exam ARM 402 framework? Option A. Increasing the volume of risk reports generated during the monitoring phase to demonstrate comprehensive oversight, regardless of the impact on actual risk mitigation. Option B. Significantly reducing premiums for insurance policies without a thorough reassessment of the organization's risk profile and control effectiveness. Option C. implementing a new, highly automated system for rapid risk identification, prioritizing speed over detailed analysis. Option D, systematically reviewing and refining each stage of the risk management process, identification, analysis, control, financing, and monitoring, to eliminate redundancies and improve workflow. The correct answer is D, systematically reviewing and refining each stage of the risk management process, identification, analysis, control, financing, and monitoring, to eliminate redundancies and improve workflow. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of the risk management process and its optimization within the specific regulatory framework of the Successfully Treating Risk exam, ARM 402. The challenge lies in identifying the most effective method to improve the efficiency and efficacy of risk management without compromising its core objectives or violating regulatory mandates. Professionals must exercise careful judgment to balance process improvement with compliance and ethical considerations. The correct approach involves a systematic review and refinement of each stage of the risk management process: identification, analysis, control, financing, and monitoring, to identify bottlenecks, redundancies, or inefficiencies. This approach is correct because it directly addresses the core components of risk management as outlined in the ARM 402 curriculum. By optimizing each phase, an organization can achieve a more proactive, responsive, and cost-effective risk management program. This aligns with the regulatory expectation of robust and efficient risk management practices, ensuring that risks are identified early, analyzed thoroughly, controlled effectively, financed appropriately, and monitored continuously. The ethical imperative is to manage resources prudently and to ensure that risk management activities genuinely protect the organization and its stakeholders. An incorrect approach that focuses solely on accelerating the risk identification phase without a corresponding enhancement in analysis or control would be professionally unacceptable. This failure stems from a misunderstanding of the interconnectedness of the risk management process. Rapid identification without adequate analysis can lead to misprioritization of risks, wasted resources on minor issues, or overlooking critical threats. This violates the regulatory expectation of thorough risk assessment and can lead to ethical breaches if significant risks are not properly addressed due to haste. Another incorrect approach that prioritizes cost reduction in risk financing without a comprehensive review of the underlying risks and their control measures is also professionally flawed. This approach might lead to underinsurance or the selection of financing mechanisms that are inadequate for the actual risk exposure. This directly contravenes the regulatory requirement for appropriate risk financing and can expose the organization to significant financial distress, failing the ethical duty to ensure financial stability and solvency. A further incorrect approach that emphasizes extensive documentation and reporting for the monitoring phase, while neglecting the actual implementation and effectiveness of control measures, is also unacceptable. This creates a false sense of security and compliance. The regulatory framework expects tangible risk mitigation, not just paper trails. Ethically, this approach misleads stakeholders about the true state of risk management within the organization. The professional decision-making process for similar situations should involve a holistic review of the entire risk management framework. Professionals should ask, does the proposed optimization enhance the effectiveness of risk identification, analysis, control, financing, and monitoring? Does it align with the specific regulatory requirements of ARM 402? Does it uphold ethical principles of due diligence, prudence, and stakeholder protection? A structured approach, perhaps using a risk management maturity model or a process mapping exercise, can help identify areas for improvement that are both compliant and strategically beneficial. Question 6. Governance review demonstrates that the firm's current risk identification process is heavily reliant on a single methodology. To enhance the effectiveness and comprehensiveness of risk identification, which of the following approaches would best align with regulatory expectations for a robust risk management framework? Option A, primarily reviewing publicly available industry risk reports and competitor analyses. Option B, relying exclusively on interviews with senior management to gather their perspectives on potential risks. Option C, solely analyzing historical loss data and past audit findings to identify recurring risk patterns. Option D, conducting cross-functional risk workshops and developing detailed scenario analyses to explore potential future events. The correct answer is D. Conducting cross-functional risk workshops and developing detailed scenario analyses to explore potential future events. Explanation. This scenario is professionally challenging because it requires the risk manager to select the most appropriate risk identification technique from a range of options, each with potential benefits and drawbacks. The challenge lies in aligning the chosen technique with the specific context of the organization and the nature of the risks being investigated, while adhering to regulatory expectations for thorough risk assessment. Careful judgment is required to avoid superficial analysis or the adoption of techniques that are ill-suited to the task, which could lead to missed risks or inefficient resource allocation. The correct approach involves utilizing a combination of structured and unstructured risk identification techniques that encourage broad participation and leverage diverse perspectives. This approach is best professional practice because it aligns with regulatory expectations for a comprehensive risk assessment process. Specifically, regulatory frameworks often mandate that firms establish and maintain robust systems and controls for identifying, assessing, and managing risks. Employing techniques like workshops with cross-functional teams and scenario analysis allows for the systematic exploration of potential risks from various angles, increasing the likelihood of uncovering both known and emerging threats. This collaborative and analytical method ensures that the identification process is not solely reliant on the insights of a single individual or department, thereby enhancing the quality and completeness of the risk register. An incorrect approach that relies solely on historical incident data fails to adequately address emerging risks or those that have not yet manifested. This is a regulatory failure because it may not meet the requirement for forward-looking risk assessment and could leave the organization vulnerable to unforeseen events. It also represents an ethical failure if it leads to a false sense of security by overlooking potential future threats. Another incorrect approach that focuses exclusively on expert interviews, while valuable, can be limited by the biases or knowledge gaps of the individuals interviewed. This can lead to a narrow view of risks and may miss systemic issues or risks that are not readily apparent to those in specific roles. This is a professional failure as it may not provide a holistic view of the risk landscape, potentially failing to meet the due diligence expected in risk management. A further incorrect approach that involves only a review of external industry reports overlooks the unique operational context and specific vulnerabilities of the organization. While industry trends are important, they do not capture the internal factors that contribute to risk. This is a regulatory failure as it may not demonstrate sufficient understanding of the firm's own risk profile and could lead to the misapplication of generic risk mitigation strategies. The professional decision-making process for similar situations should involve a structured approach to risk identification. This begins with understanding the objectives of the risk assessment and the scope of the review. Next, consider the nature of the organization, its industry, and its operational environment. Then, evaluate various risk identification techniques, considering their strengths, weaknesses, and suitability for the specific context. A balanced approach often involves combining multiple techniques to triangulate findings and ensure comprehensive coverage. Finally, document the chosen techniques and the rationale for their selection, ensuring transparency and auditability. Question 7. Quality control measures reveal that an insurance entity is considering the implementation of a new AI-driven customer profiling system designed to personalize marketing offers. Before proceeding, what is the most appropriate initial step to ensure legal and regulatory compliance? Option A. Rely on the vendor's assurances that the AI system meets all relevant industry standards and regulations. Option B. Conduct a comprehensive impact assessment focusing on data privacy, consumer protection laws, and specific regulatory requirements related to AI and data usage. Option C. Proceed with implementation, assuming that existing general compliance policies adequately cover the new system's operations. Option D. Prioritize the technical feasibility and potential market advantage of the AI system, deferring detailed legal review until after deployment. Correct answer is B. Conduct a comprehensive impact assessment focusing on data privacy, consumer protection laws, and specific regulatory requirements related to AI and data usage. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance entity to balance its commercial objectives with its legal and regulatory obligations concerning data privacy and consumer protection. The pressure to leverage new technologies for competitive advantage must be carefully weighed against the stringent requirements of data handling and the potential for harm to consumers if these regulations are not adhered to. Misinterpreting or ignoring these legal and regulatory frameworks can lead to significant financial penalties, reputational damage, and loss of consumer trust. Correct approach analysis. The correct approach involves conducting a thorough impact assessment that specifically evaluates the potential risks to consumer data privacy and compliance with relevant regulations, such as those governing data protection and fair marketing practices. This assessment should identify specific legal requirements, such as consent mechanisms, data minimization principles, and transparency obligations, and determine how the proposed technology aligns with or deviates from these. By proactively identifying and mitigating risks in alignment with regulatory mandates, the entity demonstrates due diligence and a commitment to responsible innovation, thereby safeguarding both consumer interests and its own legal standing. Incorrect approaches analysis. An approach that prioritizes immediate market advantage without a comprehensive regulatory impact assessment fails to acknowledge the legal framework governing data handling and consumer rights. This oversight can lead to violations of data protection laws, resulting in fines and legal action. An approach that assumes existing general compliance is sufficient for a new technology, without a specific assessment of its unique data processing activities, is also flawed. Regulatory frameworks often have specific provisions for new technologies or novel data uses, and a generic assumption can lead to non-compliance with these specific requirements. An approach that focuses solely on the technical feasibility of the technology, disregarding the legal and ethical implications of data usage, is professionally irresponsible. While technical innovation is important, it must operate within the established legal boundaries designed to protect individuals and ensure fair market practices. Professional reasoning. Professionals should adopt a risk-based approach that integrates legal and regulatory considerations from the outset of any new initiative. This involves 1. Identifying all applicable laws and regulations. 2. Assessing the potential impact of the initiative on compliance with these laws. 3. Developing mitigation strategies for identified risks. 4. Seeking legal counsel when necessary. 5. Documenting the assessment and decision-making process. This systematic approach ensures that innovation is pursued responsibly and ethically, minimizing legal exposure and fostering consumer trust. Question 8. The efficiency study reveals that implementing a new automated claims processing system could significantly reduce operational costs by 20% within the next fiscal year. However, preliminary analysis suggests this automation might increase the risk of erroneous claim payouts due to potential system glitches and a reduced human oversight layer. The organization has a stated risk appetite that prioritizes financial stability and regulatory compliance, with a specific tolerance for operational errors that could lead to significant financial loss or regulatory sanctions, which approach best aligns with the organization's commitment to successfully treating risk. Option A. Implement the automated system with a partial rollout in a controlled environment, allowing for continuous monitoring and adjustment to ensure it operates within the defined risk tolerance before a full-scale deployment. Option B. Reject the automated system entirely due to the identified risk of erroneous payouts, prioritizing the avoidance of any potential operational errors over cost savings. Option C. Delay the implementation of the automated system until a comprehensive risk assessment is completed, including a detailed analysis of potential system vulnerabilities and their impact on the organization's risk tolerance, and develop robust mitigation strategies. Option D. Proceed with the full implementation of the automated system immediately to capture the projected cost savings, assuming that any system glitches can be addressed reactively. Correct answer is D. Proceed with the full implementation of the automated system immediately to capture the projected cost savings, assuming that any system glitches can be addressed reactively. Explanation. This scenario is professionally challenging because it requires balancing the pursuit of operational efficiency with the fundamental principles of risk management, specifically within the defined risk appetite and tolerance of the organization. The pressure to demonstrate cost savings can lead to shortcuts that inadvertently increase exposure to unacceptable risks. Careful judgment is required to ensure that efficiency gains do not compromise the organization's ability to operate within its stated risk boundaries and regulatory obligations. The correct approach involves a thorough assessment of how the proposed efficiency measures impact the organization's risk profile against its established risk appetite and tolerance levels. This means not just identifying potential cost savings, but also quantifying and evaluating the associated risks. If the efficiency measures push the organization beyond its risk tolerance, they must be modified or rejected. This aligns with regulatory expectations that organizations actively manage their risks within defined parameters and maintain a robust risk culture. Ethically, it upholds the duty to protect the organization's assets and stakeholders from undue risk. An incorrect approach that prioritizes cost savings above all else, without adequately considering the risk implications, fails to adhere to the organization's risk appetite framework. This can lead to regulatory breaches if the increased risk exposure violates specific compliance requirements or supervisory expectations. Ethically, it demonstrates a disregard for prudent risk management and potentially exposes the organization to financial losses or reputational damage, betraying the trust placed in management. Another incorrect approach is to implement efficiency measures without a clear understanding of the organization's risk appetite and tolerance. This can result in unintended consequences, where risks are taken that are either too high or too low relative to the organization's strategic objectives and risk-bearing capacity. This lack of alignment can lead to inefficient resource allocation and a failure to achieve strategic goals, as well as potential regulatory scrutiny for not having a well-defined and adhered to risk management framework. A further incorrect approach might involve assuming that all efficiency measures are inherently risk-reducing. This is a flawed assumption, as many efficiency initiatives, such as outsourcing or rapid technological adoption, can introduce new or amplify existing risks if not properly managed and monitored. This oversight can lead to significant unforeseen problems and a failure to meet risk management objectives. The professional decision-making process for similar situations should involve a structured risk assessment integrated into the efficiency study. This includes 1. Clearly defining the organization's risk appetite and tolerance levels. 2. Identifying all potential risks associated with proposed efficiency measures. 3. Quantifying and evaluating these risks against the established appetite and tolerance. 4. Developing mitigation strategies for any risks that exceed tolerance. 5. Making a final decision based on a holistic view of efficiency gains versus risk exposure, ensuring alignment with regulatory requirements and ethical responsibilities. Question 9. Compliance review shows that Global Tech Inc. is experiencing a significant backlog in fulfilling customer orders due to ongoing geopolitical instability affecting its primary overseas component supplier. Management is debating whether this situation constitutes a risk that requires formal risk treatment under the Successfully Treating Risk Exam, ARM 402 framework. Which of the following best defines the situation as a risk according to the ARM 402 framework? Option A. The current backlog of customer orders, which is a known operational issue that needs immediate resolution. Option B. The uncertainty surrounding the duration and severity of the geopolitical instability and its potential to further disrupt the supply chain and impact future order fulfillment. Option C. The fact that the supply chain is dependent on an overseas supplier, which is an inherent operational characteristic. Option D. The immediate financial losses incurred due to delayed shipments and potential customer dissatisfaction. The correct answer is B. The uncertainty surrounding the duration and severity of the geopolitical instability and its potential to further disrupt the supply chain and impact future order fulfillment. Explanation. This scenario is professionally challenging because it requires distinguishing between a potential risk event and a known operational issue, both of which can impact an organization's financial stability and reputation. The core difficulty lies in applying the definition of risk consistently and accurately within the context of the Successfully Treating Risk Exam, ARM 402 framework, which emphasizes the uncertainty of future outcomes. Careful judgment is required to avoid misclassifying operational inefficiencies as risks, which could lead to misallocation of resources and ineffective mitigation strategies. The correct approach involves identifying the uncertainty inherent in the situation. Risk, by definition, is the effect of uncertainty on objectives. In this case, The potential for a supply chain disruption due to geopolitical instability represents an uncertain future event with a potential negative impact on the company's ability to meet its production targets. This aligns with the ARM 402 understanding of risk as a future possibility, not a current certainty. An incorrect approach would be to classify the current backlog of customer orders as the primary risk. While the backlog presents a challenge, it is a current, known operational issue, not an uncertain future event. Treating it as a risk would misapply the definition and lead to focusing on immediate operational fixes rather than proactive risk management for future uncertainties. Another incorrect approach would be to focus solely on the immediate financial impact of the supply chain issue without considering the underlying uncertainty. Risk management requires understanding the root causes and the potential for variation in outcomes. Ignoring the uncertainty of how long the geopolitical instability will last or its full impact on the supply chain would be a failure to address the core of the risk. A further incorrect approach would be to dismiss the supply chain issue entirely as an external factor beyond the company's control and therefore not a risk to be managed. While external factors can be challenging, the company's objective is to maintain production. The uncertainty surrounding the supply chain's ability to support this objective, due to external factors, constitutes a risk that needs to be addressed through appropriate risk treatment. Professionals should approach such situations by first clearly defining the company's objectives. Then, they should identify potential events or conditions that could prevent the achievement of those objectives. For each identified event, they must assess the degree of uncertainty and the potential impact. This systematic process ensures that resources are directed towards managing genuine risks, characterized by uncertainty, rather than simply addressing current operational problems. Question 10. The control framework reveals a significant number of potential risks identified across various business units. The risk management team is tasked with prioritizing these risks for further mitigation planning, which approach best aligns with the principles of an effective enterprise risk management framework for this prioritization. Option A. Prioritize risks based on the immediate cost savings that can be achieved by implementing controls, regardless of the actual risk exposure. Option B. Prioritize risks solely based on the frequency of their occurrence in historical data, without considering potential future changes or emerging threats. Option C. Prioritize risks based on a comprehensive assessment of their potential impact on the organization's strategic objectives and overall value, considering both quantitative and qualitative factors. Option D. Prioritize risks based on the ease and speed with which mitigation strategies can be implemented, focusing on quick wins. The correct answer is C. Prioritize risks based on a comprehensive assessment of their potential impact on the organization's strategic objectives and overall value, considering both quantitative and qualitative factors. Explanation. This scenario is professionally challenging because it requires a risk manager to move beyond a purely compliance-driven approach to ERM and instead focus on the strategic implications of identified risks. The pressure to demonstrate immediate cost savings can lead to a superficial assessment of risks, neglecting their potential impact on the organization's long-term objectives and competitive position. Careful judgment is required to balance the need for efficiency with the imperative of robust risk management that supports sustainable value creation. The correct approach involves conducting a thorough impact assessment that considers both the likelihood and the potential consequences of identified risks across various dimensions, including financial, operational, strategic, and reputational. This assessment should inform the prioritization of risks and the development of appropriate mitigation strategies that align with the organization's risk appetite and strategic goals. This aligns with the principles of effective ERM frameworks, which emphasize integrating risk management into strategic planning and decision-making processes to enhance organizational resilience and performance. Regulatory guidance, such as that provided by the Committee of Sponsoring Organizations of the Treadway Commission, COSO, ERM framework, stresses the importance of understanding the potential impact of risks on achieving objectives. An incorrect approach that focuses solely on the cost of implementing controls without considering the potential financial or non-financial impact of the risk materializing is professionally unacceptable. This failure to assess impact can lead to under-resourcing critical risk mitigation efforts, leaving the organization vulnerable to significant losses or disruptions. It represents a deviation from the core purpose of ERM, which is to manage risks that could prevent the organization from achieving its objectives. Another incorrect approach that prioritizes risks based on the ease of mitigation rather than their potential impact is also professionally flawed. This can result in overlooking high-impact, low-probability risks that, if they occur, could have catastrophic consequences. This approach prioritizes short-term convenience over long-term security and strategic advantage, failing to adequately protect the organization's value. A further incorrect approach that relies solely on historical data without considering emerging trends or future uncertainties is inadequate. While historical data is valuable, it may not accurately reflect the evolving risk landscape. Failing to incorporate forward-looking analysis can lead to a false sense of security and an inability to anticipate and prepare for new or escalating risks. A professional decision-making process for similar situations should involve a structured approach to risk assessment that begins with identifying risks, followed by a comprehensive analysis of their potential impact and likelihood. This analysis should then inform the prioritization of risks and the selection of appropriate risk responses, ensuring that these responses are aligned with the organization's strategic objectives and risk appetite. Continuous monitoring and review are essential to adapt to changing circumstances and maintain the effectiveness of the framework. Question 11. Cost-benefit analysis shows that implementing a new, comprehensive cybersecurity protocol would significantly reduce the likelihood of a data breach, but at a substantial upfront cost. An alternative, less expensive approach involves enhancing existing basic security measures, which would offer some protection but leave a higher residual risk of a breach. The organization's risk appetite statement indicates a low tolerance for data security incidents. Which of the following approaches best aligns with a prudent and compliant risk management strategy in this context? Option A. Adopt the less expensive approach of enhancing existing basic security measures to manage costs, accepting the higher residual risk of a data breach. Option B. Implement the less expensive approach of enhancing existing basic security measures and allocate the remaining budget to other operational areas. Option C. Implement the new, comprehensive cybersecurity protocol, as the reduction in potential breach likelihood and alignment with the low-risk appetite outweigh the significant upfront cost. Option D. Defer any significant investment in cybersecurity until a breach actually occurs to avoid unnecessary expenditure. The correct answer is C. Implement the new, comprehensive cybersecurity protocol, as the reduction in potential breach likelihood and alignment with the low-risk appetite outweigh the significant upfront cost. Explanation. This scenario presents a professional challenge because it requires balancing the financial implications of a risk treatment strategy against its effectiveness in protecting the organization. The challenge lies in objectively evaluating the intangible benefits of risk mitigation, such as reputational protection and enhanced stakeholder confidence, alongside quantifiable cost savings. Professionals must exercise careful judgment to ensure that the chosen approach aligns with the organization's risk appetite and regulatory obligations, rather than solely focusing on immediate cost reduction. The correct approach involves a comprehensive cost-benefit analysis that considers both direct and indirect costs and benefits, including qualitative factors. This aligns with the principles of prudent risk management, which emphasizes a holistic view of risk treatment. Regulatory frameworks, such as those governing financial services or insurance, often mandate that risk management decisions be demonstrably in the best interest of the organization and its stakeholders, which includes considering the long-term implications of risk exposure. Ethical considerations also demand that decisions do not expose the organization to undue or unmanaged risks, even if the immediate cost savings appear attractive. An incorrect approach that prioritizes short-term cost savings without adequately assessing the potential for increased residual risk fails to meet regulatory expectations for robust risk management. This can lead to significant financial and reputational damage if an unmitigated risk event occurs. Another incorrect approach that overemphasizes the cost of mitigation without a thorough evaluation of the potential benefits, including non-financial ones, may lead to underinvestment in critical risk controls, leaving the organization vulnerable. Focusing solely on the most expensive mitigation option without considering less costly but equally effective alternatives represents a failure in efficient resource allocation and prudent risk management. Professionals should employ a decision-making framework that begins with clearly defining the risk and its potential impact. This is followed by identifying and evaluating various treatment options, including their associated costs and benefits. The analysis should incorporate both quantitative and qualitative assessments, considering the organization's risk appetite and regulatory environment. The chosen strategy should then be implemented and regularly reviewed to ensure its continued effectiveness and alignment with evolving circumstances. Question 12. Governance review demonstrates that the firm has conducted a SWOT analysis to assess its risk management capabilities. Which of the following best represents the most effective and compliant approach to utilizing these SWOT findings within the Successfully Treating Risk Exam ARM 402 framework? Option A. The SWOT analysis findings are integrated into the firm's risk register, leading to the development of specific risk mitigation plans for identified weaknesses and threats, and strategies to leverage strengths and opportunities. Option B. The SWOT analysis is conducted by an external consultant, and their report is filed away as a compliance document. Option C. The SWOT analysis is used to identify strategic growth opportunities, with minimal focus on the identified weaknesses and threats. Option D. The SWOT analysis findings are documented and shared with senior management, with a plan to revisit the analysis annually. The correct answer is D. The SWOT analysis findings are documented and shared with senior management, with a plan to revisit the analysis annually. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how to effectively leverage a SWOT analysis within the specific regulatory context of the Successfully Treating Risk Exam, ARM 402. The challenge lies in moving beyond a superficial identification of SWOT elements to a strategic application that aligns with regulatory expectations for risk management and governance. Careful judgment is required to ensure the analysis is not merely descriptive but actionable and compliant. The correct approach involves integrating the SWOT analysis findings directly into the firm's risk management framework, ensuring that identified weaknesses and threats are addressed through specific mitigation strategies, and that strengths and opportunities are leveraged to enhance resilience and compliance. This aligns with regulatory expectations for a proactive and integrated approach to risk management, where strategic planning is informed by a thorough understanding of internal capabilities and external environmental factors. The regulatory framework for ARM 402 emphasizes the importance of robust risk identification, assessment, and mitigation, which a well-executed SWOT analysis directly supports. By linking SWOT outcomes to concrete risk treatment plans, the firm demonstrates a commitment to effective risk governance and operational integrity, as mandated by the principles underlying such examinations. An incorrect approach would be to treat the SWOT analysis as a standalone exercise, disconnected from the firm's operational risk management processes. This failure to integrate the findings into actionable strategies represents a significant regulatory and ethical lapse. It suggests a superficial engagement with risk assessment, where the output of the analysis is not used to drive meaningful change or improvement. This can lead to unaddressed weaknesses and threats, increasing the firm's vulnerability and potentially contravening regulatory requirements for due diligence and risk mitigation. Another incorrect approach involves focusing solely on the opportunities and strengths aspects of the SWOT analysis while neglecting the weaknesses and threats. This selective application is ethically problematic, as it demonstrates a lack of commitment to comprehensive risk management. Regulators expect a balanced assessment that acknowledges and addresses potential downsides. Ignoring weaknesses and threats can lead to a false sense of security and leave the firm exposed to unforeseen risks, violating the spirit and letter of regulations designed to ensure financial stability and consumer protection. A further incorrect approach is to conduct the SWOT analysis without considering the specific regulatory landscape relevant to the firm's operations. This oversight is a critical regulatory failure. The ARM 402 exam specifically tests the ability to apply risk management principles within a defined regulatory framework. A SWOT analysis that does not account for regulatory compliance, changes in legislation, or supervisory expectations is fundamentally flawed and fails to meet the core objectives of effective risk treatment. It indicates a lack of awareness of the external environment's impact on the firm's risk profile. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the objectives of the SWOT analysis in the context of regulatory requirements. Second, ensure the analysis is comprehensive, covering all 4 quadrants of SWOT. Third, critically evaluate the findings, identifying actionable insights. Fourth, prioritize these insights based on their potential impact on risk and compliance. Finally, integrate the prioritized insights into the firm's strategic planning and risk management framework, establishing clear ownership and timelines for mitigation and leverage activities, and regularly reviewing their effectiveness. Question 13. The control framework reveals a potential operational failure in a critical system that, if unaddressed, could lead to a significant data breach. While the immediate impact appears contained, the underlying vulnerability is substantial. The department head suggests addressing the issue internally and not formally reporting it to avoid unnecessary scrutiny and potential negative performance reviews for the team. What is the most appropriate course of action? Option A. Immediately report the potential operational failure through the established incident reporting channels, detailing the nature of the vulnerability and its potential consequences. Option B. Report the incident but omit specific details about the underlying vulnerability to avoid causing undue alarm. Option C. Address the issue internally and document the resolution without formal reporting, as the immediate impact is perceived as minimal. Option D. Discuss the issue with the department head and agree to monitor the situation closely without immediate formal reporting, pending further assessment. Correct answer is A. Immediately report the potential operational failure through the established incident reporting channels, detailing the nature of the vulnerability and its potential consequences. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need to address a potential operational failure with the ethical obligation to report incidents accurately and transparently, even when doing so might have negative personal or departmental consequences. The pressure to downplay or delay reporting can arise from fear of repercussions, a desire to avoid scrutiny, or a misguided attempt to protect the department's reputation. Careful judgment is required to navigate these pressures and uphold the integrity of the risk management process. The correct approach involves immediately reporting the identified issue through the established incident reporting channels, regardless of its perceived severity or potential impact. This aligns with the principles of proactive risk management and regulatory compliance. Specifically, within the Successfully Treating Risk Exam, ARM 402 framework, which emphasizes robust internal controls and transparent reporting, prompt and accurate incident reporting is a cornerstone. It allows for timely investigation, root cause analysis, and the implementation of corrective actions to prevent recurrence. This adheres to the ethical duty of candor and the regulatory expectation that organizations maintain effective systems for identifying and addressing operational risks. An incorrect approach would be to delay reporting or to attempt to resolve the issue informally without documenting it. This failure to report an identified control weakness or potential operational failure violates the core tenets of risk management and regulatory compliance. It creates a blind spot, preventing senior management and relevant oversight bodies from understanding the organization's risk landscape. Such an approach can lead to the escalation of the issue, potentially resulting in more significant financial losses, reputational damage, or regulatory penalties. Ethically, it represents a breach of trust and a dereliction of professional duty. Another incorrect approach would be to report the incident, but to deliberately omit or minimize key details to make it appear less significant. This misrepresentation undermines the purpose of incident reporting, which is to provide a clear and accurate picture of events. It hinders effective investigation and the development of appropriate mitigation strategies. From a regulatory and ethical standpoint, this constitutes a dishonest reporting practice, which can have severe consequences for both the individual and the organization. The professional decision-making process for similar situations should involve a clear understanding of the organization's incident reporting policy and procedures. Professionals should prioritize transparency and accuracy, recognizing that timely and complete reporting is essential for effective risk management and regulatory compliance. If unsure about the reporting threshold or the appropriate level of detail, seeking guidance from a supervisor or the compliance department is a prudent step. The ultimate goal is to ensure that all identified risks are appropriately managed and that the organization operates with integrity. Question 14. System analysis indicates that a manufacturing facility experiences a significant fire originating from a faulty piece of machinery. The fire causes extensive damage to the building and its contents, injures 2 employees working in the vicinity, and also spreads to an adjacent property, causing smoke damage to its exterior. The business holds a commercial property insurance policy, a general liability insurance policy, and a workers' compensation insurance policy, which insurance policy type is primarily responsible for covering the damage to the building and its contents. Option A, the workers' compensation insurance policy. Option B, the commercial property insurance policy. Option C, the general liability insurance policy. Option D, a combination of all 3 policies equally. The correct answer is B, the commercial property insurance policy. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how different insurance policy types respond to a single, complex event. The challenge lies in accurately identifying the primary policy responsible for covering the core loss versus secondary or supplementary policies that might offer additional coverage or address different facets of the claim. Misidentification can lead to significant delays, underpayment, or denial of claims, impacting client trust and potentially leading to regulatory scrutiny. Careful judgment is required to dissect the event's impact across various insurance domains. The correct approach involves a systematic analysis of the event's nature and the specific perils covered by each policy type. It prioritizes the policy designed to address the most direct and substantial loss arising from the event. For instance, if a fire damages a building, the property insurance policy is the primary responder for the physical damage to the structure and its contents. Liability insurance would only come into play if the fire caused damage to a third party's property or resulted in bodily injury to someone other than the insured. Workers' compensation would be relevant only if an employee sustained an injury during the incident. This approach aligns with the fundamental principles of insurance contract interpretation, where the policy most directly and comprehensively addressing the insured peril is triggered first. Regulatory frameworks, such as those governing claims handling and fair practices, mandate that insurers act diligently and in good faith, which includes correctly identifying and applying the appropriate coverage. An incorrect approach would be to assume that all policies held by the insured are automatically triggered by any event affecting their operations. For example, assuming a general liability policy will cover the direct physical damage to a business's own property from a fire would be a failure. This ignores the distinct purpose and scope of property insurance. Similarly, applying workers' compensation coverage to property damage would be a misapplication, as this policy is specifically designed for employee injuries. These misapplications represent regulatory and ethical failures because they demonstrate a lack of understanding of policy terms and conditions, potentially leading to improper claim handling, misrepresentation of coverage, and a breach of the duty of care owed to the insured. Such actions can result in regulatory penalties for unfair claims settlement practices. The professional decision-making process for similar situations should involve a thorough review of the insured's policy portfolio, a detailed understanding of the event's circumstances and its direct and indirect consequences, and a clear application of the specific coverage grants and exclusions within each relevant policy. This process should prioritize identifying the policy that most directly addresses the primary loss, followed by assessing any secondary or supplementary coverages that may apply. Consulting with claims adjusters and legal counsel specializing in insurance law is advisable when the event's impact is complex or spans multiple policy types. Question 15. The evaluation methodology shows that a critical operational process has a high likelihood of experiencing a minor but frequent disruption. This disruption, while not catastrophic, leads to a cumulative loss of productivity and increased administrative overhead. Which risk control technique is most appropriate to address this situation, adhering to the principles of effective risk management? Option A. Seek to transfer the risk of disruption to a third-party service provider without a formal contractual agreement. Option B. Accept the risk and allocate a contingency fund to cover the ongoing administrative overhead and lost productivity. Option C. Invest in a complete overhaul of the operational process, replacing all existing technology with a significantly more expensive cutting-edge system. Option D. Implement a robust preventative maintenance schedule for all equipment involved in the process and provide enhanced training to personnel on best practices for process execution. The correct answer is D. Implement a robust preventative maintenance schedule for all equipment involved in the process, and provide enhanced training to personnel on best practices for process execution. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of risk control techniques and their application within the specific regulatory framework of the Successfully Treating Risk Exam ARM 402. The challenge lies in identifying the most appropriate and compliant risk control technique when faced with a situation where multiple options might seem superficially relevant. Careful judgment is required to distinguish between techniques that merely mitigate risk and those that actively control or transfer it in a manner consistent with regulatory expectations. The correct approach involves selecting a risk control technique that directly addresses the identified risk by implementing measures to reduce its likelihood or impact, aligning with the principles of effective risk management as outlined in the ARM 402 curriculum. This approach is right because it demonstrates a proactive and systematic effort to manage potential losses. Regulatory justification stems from the emphasis within risk management frameworks on implementing practical and effective controls. Ethically, it aligns with the duty to protect the organization's assets and stakeholders from undue harm. An incorrect approach that focuses solely on risk acceptance without any mitigating actions fails to meet the proactive risk management standards expected. This is a regulatory failure because it neglects the responsibility to actively manage identified risks. Another incorrect approach that involves implementing a control measure that is disproportionately expensive or complex relative to the risk it aims to mitigate is also professionally unacceptable. This represents a failure in efficient resource allocation and potentially a misinterpretation of the cost-benefit analysis inherent in risk control. A third incorrect approach that relies on an external party to assume the risk without a formal transfer mechanism, such as insurance or a contractual agreement, is problematic. This is a regulatory and ethical failure as it creates ambiguity and potential for uncovered losses, undermining the principle of clear risk ownership and management. Professionals should approach such situations by first thoroughly identifying and assessing the specific risk. Then, they should evaluate potential control techniques against established criteria, including effectiveness, feasibility, cost-benefit, and regulatory compliance. The decision-making process should prioritize techniques that offer the most robust and compliant solution for managing the risk, ensuring that the chosen method aligns with the organization's risk appetite and strategic objectives. Question 16. Process analysis reveals that a specific operational practice within the organization has been identified as carrying a high probability of causing significant financial loss due to potential equipment failure. The current risk treatment strategy primarily relies on insurance to cover potential losses. Which of the following approaches best aligns with the principles of risk avoidance and regulatory compliance for this scenario? Option A. Acknowledge the risk but decide to accept it without implementing any further treatment measures. Option B. Continue the operational practice but increase the insurance coverage to a higher level. Option C. Implement enhanced maintenance procedures for the equipment to reduce the likelihood of failure. Option D. Cease the operational practice entirely or modify it to eliminate the possibility of equipment failure. The correct answer is D. Cease the operational practice entirely or modify it to eliminate the possibility of equipment failure. Explanation: this scenario presents a professional challenge because it requires a nuanced understanding of risk avoidance strategies within the specific regulatory framework of the Successfully Treating Risk Exam ARM 402. The challenge lies in identifying the most appropriate and compliant method of risk avoidance when faced with a potentially hazardous operational practice. Careful judgment is required to ensure that the chosen approach not only mitigates the identified risk, but also adheres strictly to the principles and guidelines governing risk management in this context, without introducing new or unmanaged risks. The correct approach involves a proactive and comprehensive assessment of the operational practice to determine if it can be eliminated or significantly modified to prevent the risk from materializing. This aligns with the core principle of risk avoidance, which prioritizes preventing losses by not engaging in activities that carry unacceptable risks. Regulatory compliance is achieved by demonstrating a systematic and documented process of identifying, evaluating, and treating risks, with avoidance being the most preferred treatment if feasible. This approach is ethically sound as it prioritizes the safety and financial well-being of the organization and its stakeholders by addressing risks at their source. An incorrect approach that involves continuing the operational practice while implementing only mitigation measures fails to fully embrace the concept of risk avoidance. While mitigation is a valid risk treatment, it is secondary to avoidance when avoidance is possible. This approach might be seen as a failure to adequately consider the most effective risk treatment option, potentially leading to regulatory scrutiny if the residual risk remains significant and avoidance was a viable alternative. Another incorrect approach, which is to ignore the identified risk altogether, represents a clear failure in risk management and regulatory compliance. This demonstrates a disregard for established risk management principles and could expose the organization to significant financial and reputational damage. Ethically, it is a dereliction of duty to not address known risks. A further incorrect approach, which is to transfer the risk through insurance without attempting to avoid or mitigate it, also falls short. While insurance is a risk financing tool, it does not eliminate the underlying risk itself. Relying solely on insurance without exploring avoidance or mitigation options may be viewed as a passive approach that does not demonstrate due diligence in risk management, potentially contravening the spirit of regulatory expectations for proactive risk treatment. The professional decision-making process for similar situations should involve a structured risk management framework. This begins with risk identification, followed by a thorough risk assessment to understand the likelihood and impact. Subsequently, all available risk treatment options, including avoidance, reduction, transfer, and acceptance, should be evaluated against the organization's risk appetite and regulatory requirements. The most effective and compliant option, prioritizing avoidance where feasible, should then be implemented and continuously monitored. Question 17. The monitoring system demonstrates a novel approach to identifying potential patient safety risks within a healthcare facility by analyzing electronic health record (EHR) data. However, the implementation team is concerned about ensuring this analysis complies with the Health Insurance Portability and Accountability Act (HIPAA). Which of the following implementation strategies best ensures HIPAA compliance while maximizing the system's risk identification capabilities? Option A. Limit the monitoring system's access to only non-PHI data within the EHR, even if this significantly reduces its ability to identify critical patient safety risks. Option B. Proceed with the implementation, relying on the EHR vendor's general assurances of HIPAA compliance and assuming that standard IT security measures are sufficient to protect patient data. Option C. Conduct a comprehensive HIPAA risk assessment and develop specific data de-identification and anonymization protocols for any PHI accessed by the system, coupled with robust access controls and audit trails for authorized personnel. Option D. Implement the monitoring system with full access to all EHR data and address any potential HIPAA concerns only if a data breach is reported. Correct answer is C. Conduct a comprehensive HIPAA risk assessment and develop specific data de-identification and anonymization protocols for any PHI accessed by the system, coupled with robust access controls and audit trails for authorized personnel. Explanation. This scenario is professionally challenging because it requires balancing the operational efficiency of a new technology with stringent regulatory compliance, specifically concerning patient privacy under HIPAA. The core challenge lies in ensuring that the implementation of the monitoring system, while intended to improve risk management, does not inadvertently create new vulnerabilities or violate the Health Insurance Portability and Accountability Act, HIPAA, Privacy Rule and Security Rule. Professionals must exercise careful judgment to identify and mitigate potential breaches of protected health information. 5. Without hindering legitimate risk assessment activities. The correct approach involves a comprehensive risk assessment and mitigation strategy that is explicitly designed to comply with HIPAA. This means identifying all potential ways the monitoring system could access, store, transmit, or process PHI, and then implementing safeguards to protect that information. This includes technical safeguards like encryption and access controls, physical safeguards like secure data centers, and administrative safeguards like policies and procedures for data handling and employee training. The justification for this approach is rooted in the explicit requirements of HIPAA, which mandates that covered entities implement appropriate administrative, physical, and technical safeguards to protect the confidentiality, integrity, and availability of electronic PHI. Failure to do so can result in significant penalties, including fines and reputational damage. An incorrect approach would be to proceed with the implementation without a thorough HIPAA compliance review. This could manifest as assuming that the system's internal security features are sufficient without independent verification, or failing to establish clear protocols for how PHI will be handled by the system and its users. Such an approach risks violating HIPAA by not adequately protecting PHI, potentially leading to unauthorized access, disclosure, or breaches. Another incorrect approach would be to disable critical monitoring functions to avoid potential HIPAA issues, thereby compromising the system's intended risk management benefits and potentially failing to identify and mitigate actual risks, which could also have negative consequences for patient care and organizational security. A third incorrect approach would be to rely solely on vendor assurances of HIPAA compliance without conducting an independent due diligence process, as covered entities remain ultimately responsible for ensuring their systems and vendors meet HIPAA standards. A professional decision-making process for similar situations should involve a phased approach. First, clearly define the scope of the monitoring system and its intended use, specifically identifying any potential interaction with PHI. Second, conduct a thorough risk assessment, engaging legal and compliance experts to evaluate potential HIPAA violations. Third, develop and implement a robust mitigation plan that includes technical, physical, and administrative safeguards. Fourth, establish ongoing monitoring and auditing processes to ensure continued compliance. Finally, ensure comprehensive training for all personnel involved with the system. Question 18. Market research demonstrates that clients often seek financial advice regarding investment products that offer varying commission structures to advisors. An advisor is presented with two investment products for a client. Product A offers a standard commission, while Product B, which is also suitable for the client's stated objectives, offers a significantly higher commission to the advisor. The advisor believes both products are appropriate, but Product B would result in a substantially larger personal financial gain for them. What is the most ethically and regulatorily sound approach for the advisor in this situation? Option A. Recommend Product A as it has a lower commission to avoid any appearance of impropriety, even if Product B might offer slightly better performance metrics for the client. Option B. Recommend Product B to the client, highlighting its features that align with the client's goals, while subtly downplaying the commission difference to avoid confusing the client. Option C. Fully disclose the commission differences and the potential conflict of interest to the client, and then recommend the product that best aligns with the client's overall financial goals and risk tolerance, regardless of the commission differential. Option D. Proceed with recommending Product B without mentioning the commission structure, assuming the client is primarily focused on investment performance and not advisor compensation. The correct answer is C. Fully disclose the commission differences and the potential conflict of interest to the client, and then recommend the product that best aligns with the client's overall financial goals and risk tolerance, regardless of the commission differential. Explanation. This scenario is professionally challenging because it presents a direct conflict between a financial advisor's personal gain and their fiduciary duty to their client. The advisor has a vested interest in recommending a product that offers them a higher commission, even if it is not the most suitable or cost-effective option for the client. Navigating this requires a strong ethical compass and a clear understanding of regulatory obligations to prioritize client interests above all else. The correct approach involves transparently disclosing the commission structure and the potential conflict of interest to the client. This allows the client to make an informed decision, understanding that the advisor may benefit financially from their choice. The advisor must then recommend the product that genuinely best serves the client's needs and objectives, irrespective of the commission differential. This aligns with the core principles of acting in the client's best interest, a fundamental tenet of financial advisory regulations and ethical codes. Specifically, regulations often mandate disclosure of material conflicts of interest to ensure client autonomy and prevent undue influence. An incorrect approach of recommending the higher commission product without full disclosure is a serious regulatory and ethical failure. It breaches the duty of loyalty and good faith owed to the client, potentially leading to financial harm for the client and significant penalties for the advisor, including fines, license suspension, or revocation. This action prioritizes personal gain over client well-being, undermining trust and the integrity of the financial advisory profession. Another incorrect approach of downplaying the commission difference or framing it as a minor detail, while still disclosing it, is also problematic. While disclosure is present, the intent to minimize its significance suggests an attempt to steer the client towards the advisor's preferred option without genuine impartiality. This can still mislead the client and fail to provide the clarity needed for a truly informed decision. A further incorrect approach of avoiding the topic altogether and hoping the client doesn't inquire about commissions is a passive form of misconduct. It represents a failure to proactively manage and disclose conflicts, leaving the client vulnerable to making decisions without full awareness of potential biases. This inaction is as detrimental as active misrepresentation. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. Once identified, the next step is to assess the materiality of the conflict and its potential impact on the client. The paramount consideration must always be the client's best interest. This involves a commitment to full and transparent disclosure, allowing the client to understand the situation and make an informed choice. If the conflict cannot be effectively managed through disclosure and client consent, the professional should consider recusing themselves from the recommendation or transaction to avoid compromising their fiduciary duty. Question 19. Benchmark analysis indicates that when evaluating the implementation of a new cybersecurity protocol versus enhancing existing measures, a risk manager is considering different decision tree methodologies. Which approach best aligns with regulatory expectations for demonstrating a thorough and objective risk assessment process? Option A. Developing a decision tree that solely outlines the potential positive and negative qualitative consequences of each option, without assigning probabilities or financial values. Option B. Constructing a decision tree that quantifies the probability and potential financial impact of each outcome for each strategic option, allowing for a comparative analysis of expected values. Option C. Building a decision tree that focuses exclusively on the most optimistic and pessimistic scenarios for each option, irrespective of their likelihood. Option D. Creating a decision tree with an excessive number of detailed branches and sub-branches to capture every conceivable minor variation, even if it hinders clear interpretation. The correct answer is B. Constructing a decision tree that quantifies the probability and potential financial impact of each outcome for each strategic option, allowing for comparative analysis of expected values. Explanation. This scenario is professionally challenging because it requires a risk manager to move beyond a simple identification of potential outcomes to a structured evaluation of decision pathways and their associated risks and rewards. The core difficulty lies in selecting the most appropriate decision tree approach when faced with uncertainty and multiple strategic options, ensuring that the chosen method aligns with regulatory expectations for sound risk management practices. The correct approach involves utilizing a decision tree that explicitly incorporates the probability and impact of each potential outcome, allowing for a quantitative assessment of expected values. This method is ethically sound and regulatorily compliant because it promotes transparency and objectivity in decision-making. By assigning probabilities and potential financial or operational impacts, the risk manager can systematically compare different strategic choices, such as implementing a new risk mitigation strategy versus maintaining the status quo. This structured analysis, often leading to the calculation of expected monetary value (EMV), or similar metrics, provides a defensible basis for selecting the option that offers the most favorable risk-adjusted outcome, thereby fulfilling the duty of care to stakeholders and adhering to principles of prudent risk management expected by regulators. An incorrect approach would be to solely rely on a qualitative assessment of potential outcomes without assigning probabilities or quantifying impacts. This failure is ethically problematic as it lacks objectivity and can lead to decisions based on subjective biases rather than a data-driven evaluation of risk. Regulatorily, it falls short of the detailed risk assessment and analysis expected, potentially violating guidelines that mandate a thorough understanding of the likelihood and severity of identified risks. Another incorrect approach is to focus only on the most extreme potential outcomes, e.g., best-case and worst-case scenarios, without considering their likelihood. Understanding extreme possibilities is important, Neglecting probabilities means that a highly improbable catastrophic event could disproportionately influence the decision, leading to inefficient resource allocation. This approach is ethically questionable as it may not represent the most prudent use of resources, and it fails to meet regulatory requirements for a balanced and realistic risk assessment that considers the probability of events. A further incorrect approach is to construct a decision tree that is overly complex and includes an unmanageable number of branches and sub-branches, making it difficult to interpret and use for decision-making. While comprehensiveness is desirable, an impractical level of detail can obscure the key decision points and lead to analysis paralysis. This is ethically concerning as it hinders effective decision-making and can be seen as a failure to manage the risk management process itself efficiently. Regulatorily, it may be viewed as a lack of clarity and focus in risk assessment, failing to provide actionable insights. Professionals should employ a decision-making framework that begins with clearly defining the strategic objective and the decision to be made. This is followed by identifying all viable alternative courses of action. For each alternative, the potential outcomes, their associated probabilities, and their impacts, both positive and negative, must be systematically identified. The decision tree is then constructed to visually represent these pathways. The analysis should then focus on comparing the expected values or other relevant metrics derived from the tree to identify the optimal strategy. This process ensures that decisions are informed, defensible, and aligned with regulatory expectations for robust risk management. Question 20. Risk assessment procedures indicate that a key competitor is on the verge of launching a groundbreaking new product that could significantly disrupt the market. This innovation presents the possibility of the competitor gaining substantial market share and profits, while simultaneously posing a threat of substantial financial losses for our organization if we fail to adapt. How should this risk be primarily categorized according to the principles of risk management relevant to the successfully treating risk exam, ARM 402? Option A, fundamental risk. Option B, speculative risk. Option C, pure risk. Option D, static risk. The correct answer is B, speculative risk. Explanation. This scenario is professionally challenging because it requires the risk manager to accurately categorize risks based on their inherent nature to ensure appropriate mitigation strategies are developed. Misclassification can lead to ineffective controls, wasted resources, and ultimately, failure to protect the organization from potential losses. The core of the challenge lies in distinguishing between risks that are inherent to the business environment and those that are external and pervasive, and between risks that are a result of human action versus those that are a consequence of natural events. The correct approach involves identifying the risk as speculative. This is because the risk of a competitor launching a new, disruptive technology introduces the possibility of both significant gains, market share, increased profits, and significant losses. Regulatory frameworks, such as those guiding the successfully treating risk exam, ARM 402, emphasize the importance of understanding the potential for profit or loss when classifying risks. Speculative risks are those where there is a chance of gain or loss, distinguishing them from pure risks where only the possibility of loss exists. Effective risk management requires recognizing this distinction to implement strategies that either embrace the potential upside or mitigate the downside, depending on the organization's risk appetite. An incorrect approach would be to classify the risk as pure. This is a regulatory and ethical failure because it ignores the potential for positive outcomes. Pure risks, by definition, only present the possibility of loss. By labeling the competitor's innovation as a pure risk, the risk manager would likely focus solely on defensive measures, potentially missing opportunities to adapt and even capitalize on the competitor's actions. This misclassification would lead to an incomplete risk assessment and inadequate strategic planning, violating the principle of comprehensive risk treatment. Another incorrect approach would be to classify the risk as static. This is a failure because static risks are those that are unchanging over time and are generally associated with the natural environment or societal conditions that are relatively stable. The launch of a new technology by a competitor is inherently dynamic, representing a change in the competitive landscape and market conditions. Failing to recognize this dynamism means the risk assessment would not account for the evolving nature of the threat and the need for adaptive strategies. This oversight could lead to outdated mitigation plans that are ineffective against a rapidly changing environment, contravening the proactive and forward-looking nature of effective risk management. A further incorrect approach would be to classify the risk as fundamental. This is a failure because fundamental risks affect a large segment of the population or economy, such as natural disasters or widespread economic downturns. The risk posed by a single competitor's new technology is typically particular, affecting a specific business or industry segment. Classifying it as fundamental would lead to an overestimation of its scope and potentially misallocate resources towards broad, systemic risk mitigation strategies that are not directly applicable or efficient for addressing a specific competitive threat. This mischaracterization undermines the principle of tailoring risk management efforts to the specific nature and scope of the identified risk. The professional decision-making process for similar situations should involve a systematic categorization of identified risks. This begins with understanding the core nature of the risk. Is there a possibility of gain or loss, speculative vs. pure? Then consider its stability. Is it likely to change significantly over time, dynamic vs. static? Finally, assess its scope. Does it affect a broad population or a specific entity, fundamental vs. particular? This multifaceted approach ensures that the risk is accurately understood, allowing for the selection of the most appropriate and effective risk treatment strategies in compliance with regulatory expectations for thorough and accurate risk assessment.